Just 23% of Americans have money working for them in the stock market. It's even worse in China, France, and Germany. And while some genuinely can't afford to invest, for most people, they're being held back by lies. I'm Pete, former investment banker turned financial educator. Today, I'm exposing the 5 biggest investing myths that could be keeping you broke and giving you the truth that actually builds wealth. By the end, you'll know why these myths spread like wildfire, how they quietly sabotage your financial future, and the reality that separates the wealthy from everyone else. Myth number 1, investing is just gambling. Have you ever been to your friend's house and watched them play the lottery? They're scratching off ticket after ticket, muttering,
"This is the one. This is the one."
20 tickets later, they're down $100 and have nothing to show for it except silver dust under their fingernails and broken dreams. That's what 65% of Americans think investing looks like. A lottery ticket where you either hit the jackpot or lose everything. But here's what blew my mind when I first learned this. When you buy a lottery ticket, you're betting against mathematical impossibility. The odds of winning Powerball? 1 in 292 million. You're more likely to get struck by lightning while being attacked by a shark. But when you invest in the stock market, you're not gambling. You're becoming a business partner with companies like Apple, Microsoft, and Amazon. Every share you own gives you a piece of their profits. And here's the kicker that'll make you never think about investing the same way again. Over the past 100 years, if you'd invested in the stock market for just 1 year, you'd have lost money 30% of the time. But, and this is huge, there has never been a single 20-year period where you would have lost money, ever. The lottery doesn't offer those odds. So why does everyone think investing equals gambling? Because fear sells. The media makes billions from your anxiety. They'll scream about every market crash for weeks, but barely whisper about the recoveries that follow. But here's what they won't tell you. More than 25% of market recoveries happen within days of a crash. Days. Myth number 2, I need to be a genius to invest. Picture this. You're at Thanksgiving dinner. Your know-it-all cousin starts talking about his amazing stock picks and throws around terms like beta coefficients and EBITDA margins. Everyone nods like they understand, while you sit there feeling like you need a Harvard MBA just to buy your first stock. I felt exactly the same way until I discovered something that changed everything. In 2013, a financial newspaper ran an experiment. They pitted 3 groups against each other: professional Wall Street analysts with decades of experience, college finance students, and a cat named Mr. Whiskers. Each group got $5,000 to invest for 1 year. The professionals with their fancy degrees and Bloomberg terminals, they made $176. The finance students, they lost $160. Mr. Whiskers, the cat, he made $542. The cat chose stocks by walking across a board with company names on it. A house cat beat Wall Street's finest. And this isn't some fluke. Over the past 15 years, 88% of professional fund managers, people who get paid millions to pick stocks, failed to beat a simple index fund that just buys everything. But here's the part that'll blow your mind. That's actually incredible news for you, because it means you don't need to be a genius. You don't need to read the Wall Street Journal every morning or understand complex financial statements. You just need to do what the cat accidentally did: own a piece of everything through index funds. The biggest risk isn't picking the wrong stocks. It's never starting because you think you're not smart enough. Myth number 3, I need thousands to start. Close your eyes and picture a typical investor. You're probably seeing Gordon Gekko in a $5,000 suit, barking orders into multiple phones, managing millions from a corner office overlooking Manhattan. That Hollywood image has cost Americans trillions in lost wealth. A recent study found that 54% of non-investors think they need at least $1,000 to start investing. 1 in 4 believe they need over $10,000. But here's what happened to me that changed everything. When I was 23, broke and living paycheck to paycheck, I thought investing was for rich people. Then my coworker showed me something on his phone that made my jaw drop. He owned shares of Tesla, Apple, and Google. His total investment was only $47. How is that possible? I asked. Fractional shares, he said. I can buy $5 worth of any stock. That day, I invested my first $20. $20, the price of a pizza. And here's the math that'll make you want to start today. Someone who invests $50 monthly starting at 25 will have more money at retirement than someone who invests $200 monthly starting at 35. Why? Because their money had an extra decade to compound. Time is more powerful than money. Every millionaire started with their first dollar. The only difference? They didn't wait until they felt ready. If this is helpful to you so far, smash that like button and subscribe, because we're just getting started. I've got 2 more myths that could be costing you thousands. Myth number 4, I'm too old to start. Have you ever done this? It's 11 p.m. You can't sleep, so you pull out your phone and start playing with investment calculators. If I'd started investing $300 a month at 22 with 10% returns, I'd have $1.2 million by now. You close the app feeling like you've missed the boat forever. Stop punishing yourself for decisions you didn't make 15 years ago. Here's what that calculator doesn't show you. At 22, you probably couldn't afford $300 a month. You were eating ramen noodles and splitting Netflix passwords. But now, you're probably earning 2 to 3 times what you made in your early 20s. You can likely invest $500 or $600 monthly. Start today with $500 monthly, and you'll have over $400,000 in 15 years. That's more than most people who started earlier but could only afford $100. And here's something that'll shock you. Some of the most successful investors didn't start until their 40s or 50s. Ray Dalio didn't found Bridgewater until he was 26. Warren Buffett made 99% of his wealth after age 50. The time will pass anyway. In 15 years, you'll either have hundreds of thousands in investments, or you'll be sitting there with the same regrets you have today. Which future do you choose? Myth number 5. The market is too dangerous right now. Turn on CNBC any morning and you'll hear, "Markets in free fall. Recession fears grip Wall Street. Is this the crash investors have been dreading?" It feels like there's always a crisis making investing too risky. But here's what 150 years of market data reveals. There has never been a safe time to invest. Never. The 1970s had oil crises and 20% inflation. The 1980s brought recession fears and the Cold War. The 1990s had the dot-com bubble. The 2000s gave us 9/11 and the financial crisis. The 2010s had Brexit and trade wars. The 2020s started with a global pandemic. Yet through every single crisis, patient investors who stayed invested built generational wealth. Here's the secret Wall Street doesn't want you to know. Volatility isn't your enemy, it's your opportunity. When markets crash, stocks go on sale. When everyone's panicking and selling, that's when smart money buys. The market doesn't reward those who wait for perfect conditions. It rewards those who understand that short-term chaos creates long-term wealth. Now that you know the truth about these myths, you're probably wondering, okay, Pete, but what should I actually invest in? That's exactly what I cover in this video, where I break down the 5 best investments for beginners and the 5 you should avoid at all costs. Click here to watch it next.